Welcome everybody to our weekly Outlook webinar. My name is Ilian Yotov. I'm familiar to a lot of you, I bet, as the creator of the quarter theory method, one of the Forex market strategists at allthingsforex.com. That is my website. I also host a daily program called the All Things Forex broadcast Monday through Friday. You're welcome to join me and listen to the program. If you cannot log on to the live broadcast, which is from 8 to 9 a.m. Eastern Time every day, Monday through Friday, you certainly can find the archived broadcasts on allthingsforex.com. You can register as a member, and membership is free of charge, so no charge for that. I'd like to thank our friends at fxstreet.com for putting together these webinars. And before we continue, let me also remind you that this program is intended for educational and informational purposes only, and it should not be considered as giving any buy, sell, or hold recommendations. Today we're going to discuss the top 10 spotlight economic events for the new trading week, which, by the way, is going to be the first trading week of the month of August. Yes, another month is behind us, and a new one is ahead of us. It's going to be a very busy trading week with a lot of important economic events. We have 4 interest rate announcements from 4 major central banks. The Reserve Bank of Australia, we have the European Central Bank, the Bank of England, and the Bank of Japan, as well as a sequence of important economic data which is going to be released from the largest economy in the world, and that's the United States economy. We'll have the Institute for Supply Management indexes from the manufacturing and from the services sectors. We'll also have the personal income and outlays, which also contains the Federal Reserve's preferred gauge of inflation on Tuesday. And then that's going to lead us to the mother of all important economic data from the United States, the main gauge of the health of the United States economy and labor market, the U.S. non-farm payrolls report and employment situation, which the week is going to culminate with next Friday at 8:30 a.m. Eastern Time. The very first spotlight event for us next week I've chosen to come from the United States with the Institute for Supply Management Manufacturing Indexes. This is a leading indicator of industrial activity in the U.S. Many of you should know that the reading of 50 is the dividing line between contraction and expansion in that particular sector. And the U.S. Manufacturing sector is forecast to register another month of expansion with a reading of 55.5 in July. That is up from 55.3, so very, very small increase. I'm actually not excluding the potential for the index to be a little bit weaker than what the consensus forecasts are expecting, which would a move towards 50 again would indicate that the manufacturing sector of the U.S. economy has lost some momentum in industrial activity, and we have certainly seen the U.S. economy definitely losing momentum with the GDP report last Friday at only 1.3% on consensus forecasts of 1.6 to 1.8%. We actually had 1.3% growth in the second quarter rather of 2011 for the U.S. economy. That is down from 1.9% in the first quarter. So we're losing momentum when it comes to the economy. We'll see whether that's the case with the manufacturing and the services sector next week. Of course, the U.S. dollar has come under pressure, and the big driver of the U.S. dollar and the currency markets in general and the markets worldwide in general, not just the currency markets, has been the deadlock in Washington. The focus has really shifted from the problems in the Eurozone and the Eurozone debt crisis solely, at least in the last 2 weeks, or at least 2.5 weeks even. We have been solely focused on the problems in the U.S. The U.S., just as the Eurozone, has a debt problem, and we know that there was a lot of disagreements there between the two parties in Congress and the House, in the Senate. So there's a lot of still negotiations and discussions, and ultimately that has to lead to a vote for the United States to increase the debt ceiling in order for us not to default on our debts. That's a big concern. And on top of that, that would not be enough. The credit ratings agencies have already called for the U.S. to announce some significant amount of austerity measures, which means significant amount of spending cuts, reduction, cuts in the debt and so forth, debt reduction measures. So far, the numbers that we're hearing are 900 billion, which is less than a trillion. Not that that's a small amount of money, but when your debt is about $15 trillion, that's not as significant as the credit ratings agencies would like to see, the debt reduction. Some are estimating that it has to be up to $4 trillion in order for the United States to meet the requirements by the credit ratings agencies and not see a reduction of their cut in the credit rating, which is a AAA top credit rating, top investment grade credit rating. The United States has never lost their credit rating, but the big concern is that that could be the case if we don't get to see an agreement, if the U.S. defaults, and even if the U.S. does not default, if the spending cuts are not significant, then we might see a reduction anyway. So the market, in other words, has not really been that focused on economic data. And I think that until the debt ceiling debate and vote is finally behind us, which of course the deadline is on Tuesday, August 2nd, until maybe after that, the focus is going to be more on the situation with the U.S. economy, which we have seen from a lot of different sectors, it's losing momentum. So it may not be that much of a supportive factor for the U.S. dollar unless we get to see some improvement in U.S. economic data that is not very expected. So throughout next week, the market is going to pay attention to the U.S. economic reports, especially after August 2nd, when I think that we're going to focus a lot more as we're approaching Friday with the non-farm payrolls coming up on Friday on what really is the situation there with the labor market, which because there is very, very, what is the proper word I'm looking for? I didn't want to say dismal, because it really has been dismal. I wanted to say more of like unimpressive U.S. economic data, but when it comes to the data from the labor market, at least in the last couple of months, it really has been dismal. I mean, last month in June, we only saw a jobs creation of 18,000 jobs. So that was very disappointing. The market was expecting 5 times more, at least, of a job creation. So we'll talk about the impact that the non-farm payrolls report could have along with the other important economic events. But the first event for us is going to be the ISM Manufacturing Index. That's going to bring us, after that, to the first one of the 4 economic events, or rather interest rate announcements from major central banks. The first one's going to come next week from the Reserve Bank of Australia, which is due to announce early in the morning hours on Tuesday morning, August 2nd at 12:30 a.m. Eastern Time. Now, we discussed in the last couple of weeks that one of the 4 largest banks in Australia, which is Westpac Banking Corporation, has come out and has forecast that they're actually expecting that the Reserve Bank of Australia is going to cut interest rates by the end of 2011. It seems like after that forecast came out, we started slowly but surely seeing the market beginning to price the prospects of that. In the U.S., the Australian dollar has actually begun to lose some momentum, and I wanted to show you that to remind you of what I was showing you not too long ago, a couple of weeks ago. So we're going to go to the daily chart of the Australian dollar versus the U.S. dollar. And now this is the daily chart of the Aussie versus the dollar. Now, if you look at this line here, you will see what we called a triple top a few weeks ago. This is the triple top where the Aussie dollar pair was challenging the top of the existing channel in the last couple of months, but it was not successful as far as breaking it 3 times in a row. So it was, as I called it a few weeks ago, the Australian dollar was lacking that upward momentum that could propel it higher to produce that decisive breakout that we were looking for in order for the Australian dollar gains to continue. Because it's a very strong bullish trend. It's a multi-year bullish trend. for the Australian dollar versus the US dollar. But for the last couple of months, the pair has been somewhat confined within this smaller range. And only with a decisive breakout above that triple top resistance, which was the top of the range, a little bit below $1.08, could open the door for the US dollar pair to target the previous record highs for the Australian dollar versus the US dollar, which were a little bit above an important level in my quarters theory, which is the major large quarter point at $1.10. So, after 3 unsuccessful attempts, the Australian dollar finally, on the whole political theater in Washington that was happening, and the prospects for the U.S. to get to possibly default on their debt, or at least to see a reduction of its credit rating cut, the Australian dollar found the strength to break higher versus the U.S. dollar. Because there was a market-wide assault on the U.S. dollar, obviously. The dollar weakened not only versus the Australian dollar, but pretty much against every other major currency. So the Australian dollar broke above the resistance, which was $0.0786, and surprise, surprise, moved to the large quarter point at $1.10, targeted the all-time high at $1.1011, and about 4 days ago, it even managed to produce a new record high at $1.1074, which is now the new high that we are going to be watching. Now, obviously on the risk of origin, the end of the trading week on Friday, the end of the month, a lot of window dressing, lots of closing of some positions. It has to continue to produce brand new record highs versus the US dollar. It's as simple as that. Or is it? Will the Australian dollar be capable of continuously producing record highs, new record highs versus the dollar? Well, if you feel that the Reserve Bank of Australia is going to step on a brake pedal and is going to start cutting rates by the end of 2011, well then the Australian dollar might suffer the consequences of that. But if we get to see the Australian Central Bank next Tuesday actually coming out and saying, you know what, we feel that things are going well with the economy, inflationary pressures are rising, and therefore interest rates might need to be adjusted or would be necessary to adjust interest rates at some point. If you think that I just made this up, I didn't. I actually quoted you the statement from the last monetary policy meeting by the Reserve Bank of Australia. With that statement, the Reserve Bank of Australia said that they would consider further tightening that would be necessary at some point. So if that statement does not change on Tuesday, we can still see the door open to a potential further interest rate hike rather than a cut. And that could fuel the Australian dollar trend to continue even further. Now, you know my position about decisive breakouts above previous record highs. The breakout that we witnessed last week was a decisive one, and we should not exclude the possibility that that trend could continue further. But before that trend continues further, as I explained earlier, it's going to be very important for us to see the Australian Central Bank to be hawkish, to remain hawkish as far as interest rates are concerned. They actually issued a more hawkish statement than what the market was expecting just a couple of weeks ago, along with higher than expected inflationary pressures that we witnessed in the second quarter with the report last Tuesday. Consumer Price Index from Australia came out a little bit higher than what the market forecast was. So as long as inflationary pressures continue to increase in Australia, as long as their central bank still thinks that tightening might be necessary at some point in the near future, the Australian dollar could be well supported. And as long as the US dollar remains under pressure. But will the US dollar remain under pressure throughout next week? And what could be the factors that could actually help the US dollar? Now, I've been saying that since the last week or so, that we should not exclude the possibility that the US dollar might be due for some relief rally. Now, I'm not talking about a complete reversal of the multi-year bearish trend for the dollar versus the Australian dollar or other major currencies, such as the Swiss franc or the Japanese yen. But I think that the US dollar may be due for a relief rally. So what could be the factors that could fuel such a relief rally? Certainly, the US avoiding the credit rating cut, the debt ceiling getting increased, and the U.S. not defaulting. I don't think that that's going to be the case anyway. I don't think the U.S. will default on their debt payments. But certainly, there has been a lot of nervousness in the market, and that has put some serious pressure on the U.S. dollar. So if we get to see a little bit of a relief of that pressure on the U.S. dollar, which we might be starting to see a little bit at least in a trading session today, with some news that are now starting to break out just in the last few minutes or an hour or so. We're seeing news that lawmakers in the United States might reach an agreement on raising the debt ceiling one day before the Treasury Department has said that it will run out of cash to pay the bills. There's news that the U.S. Senate Majority Leader and his office has issued a statement that he has signed off on a proposed deal which is pending approval by Senate Democrats. So we will see what comes out. But again, the race is against the clock. The clock is ticking, and certainly August 2nd deadline is coming. So now, after a brief profit taking, a little bit of a pullback, the Australian dollar will make an attempt more than likely to continue that bullish trend, but if it does not break above these previous record highs that we established last week, that would be the first sign that a more significant price correction for the U.S. dollar's losses may have already started, and possibly even what would become a potential U.S. dollar relief rally. Will it be long-lived or short-lived? It might be short-lived, especially if the U.S. economic data is not very strong, and we get to see another, in my opinion, I think the U.S. dollar, any U.S. dollar relief rally would be short-lived if we get to see a very disappointing employment report next Friday. So a lot is riding on August 2nd deadline for the debt ceiling, and then on the employment report on Friday for that U.S. dollar relief rally scenario to potentially play out. Another major economic event next week is going to be the personal income and spending, outlays, personal consumption and expenditures. There's a couple of names that you can call this report. They all mean the same. They track the income received and purchases made by U.S. consumers. And along with these two reports, we get to see the personal consumption and expenditures price index, which is the preferred gauge of inflation by the Federal Reserve. Many other central banks actually like the consumer price index, which measures a fixed basket of goods and services. The Federal Reserve likes the personal consumption and expenditures price index better because it measures a variable basket of goods and services. On top of that, the Fed does not like to include volatile items like food and energy costs. So when we exclude these items, obviously inflationary pressures may not be as high. And that's what we might see, another sign of subdued inflationary pressures with the personal consumption and expenditures price index increasing by 0.2% month over month in July, a little bit lower increase than a 0.3% month over month in June. Consumer spending in the United States is forecast to register a small increase of 0.1% only month over month in July, compared with a flat 0% month over month reading in a previous month. So what does that mean? I'm not thinking that that's going to be a very impressive kind of an economic report that instills confidence in the economy, confidence in the consumer is ready to spend. And on top of that, if inflationary pressures are not rising significantly, if they're beginning to subside, that doesn't put any pressure on the Federal Reserve. to begin to tighten monetary policy anytime soon. So we could see more of the same. Another major economic report next week is going to come from the United States again with the automatic data processing employment report. This is the warm-up, as I like to call it, to the non-farm payrolls on Friday. Only this one does not track the private and the public sector of the U.S. economy and jobs creation there. It only tracks payrolls in the private sector of the U.S. economy. But it could be a leading indicator for the outcome of the monthly non-farm payrolls. This report is due on Wednesday at 8:15 a.m. Eastern Time, which is its usual time, a couple of days on the Wednesdays before Friday non-farm payrolls reports. Following the stronger than expected 155,000 new jobs that were created in June by the private sector of the U.S. economy, we could see slower jobs creation with the report next Wednesday of up to 110,000 in July. So if that could be an indication of things to come for Friday, if the numbers are even lower than what the market is expecting, if we get to the private sector creating less than 110,000 jobs, then that would cause some concerns that we may witness another weak economic report on Friday. So we'll watch for that with Wednesday's report. And then after that report, we're going to also see another important economic report from the United States with the ISM non-manufacturing index, which is the services industry's indicator. And the forecast is for the services industries to expand for another month to 53.7 in July from 53.3. Again, very small increase, but at least the forecasts are not expecting a decline in that index. However, as I mentioned earlier with the Monday's manufacturing index report, if the non-manufacturing index is lower than expected and we get to see that move back toward the 50, reading of 50, which is the dividing line between expansion and contraction, then that would be an indication that the services sector of the U.S. economy is also losing momentum, which may not bode very well for those who expect that we're going to have to see the Fed in a hurry to start tightening sometime sooner rather than later. Following the ISM non-manufacturing report, we're going to see the Bank of England's interest rate announcement, which I don't think that anybody is expecting the Bank of England to start hiking interest rates here, at least this year. For many weeks now on this program, we've been talking about how the market just a few months ago was pricing in that the Bank of England is going to hike rates before the summer even, possibly in May. But that certainly has not been the case. The Bank of England policymakers have been sitting on the sidelines. They have not moved interest rates any higher, despite of some market expectations being priced in. And the British pound has lost some of that strength that it has had. But for the most part, the British pound took full advantage, as I will show you with the chart of the pound versus the dollar. We're going to go to the daily chart of the pound versus the dollar here. The pound has taken full advantage of the dollar weakening in the last several weeks. As a matter of fact, the pound-dollar pair, many of you who follow my webinars on a regular basis, have been saying this pretty much for the last several months, that the pound-dollar exchange rate has been stuck within a range since February. And that range has been a little bit below $1.60, $1.59.37. You would recall that previous low here. A little bit of a lower low at $1.59.11, but pretty much above $1.59, which is approximately the bottom of that channel since February. And then the top of the range, only 5 pips below the large quarter point at $1.6750, with the highest at $1.6745 from April 28th. So this has been that range of about, 800 pips or so? A little bit less than 900 pips of a range for the pound-dollar exchange rate, where the pound versus dollar pair has been pretty much fluctuating for a number of months. Most recently, about 3 weeks ago, we actually saw risk aversion putting pressure on the British pound enough to break below $1.5911 and below the bottom of the channel and reach new lows at the $1.5779. However, the dollar immediately after that began to weaken, and the pound took full advantage of that, and the pound-dollar exchange rate went right back into its previously established range, above $1.60, on its way to challenge potentially these previous resistance levels, which were already challenged, by the way, on Friday. We had some highs at the $1.6469, not too far from the large quarter point at the $1.65. $1.6495, you would recall, were some previous resistance levels here. In the $1.65 area is an important price level. In my quarters theory, we have some previous resistance there at the $1.65, is it 65.46, the high from May 31st. So these are $1.65 area, obviously, is going to be an area of resistance. The beauty is that we're not trading like the New Zealand dollar or the Australian dollar in previously uncharted territories, producing new record highs for the Australian or the New Zealand dollar versus the US dollar. That's not the environment that the pound-dollar exchange rate is trading within. It's a familiar range that the exchange rate of the pound versus dollar has been fluctuating within for months. So therefore, previous support and resistance levels are simply going to be respected all over again. So we have to pay attention to them. And again, $1.65 area, $1.6546, those are the most immediate resistance levels that if the pound breaks above, we may even see an attempt to challenge the ultimate top of the range, which would be almost the large quarter point at the $1.6750. If the pound actually ends up failing to break all these previous highs, are of course resistance levels. If we start failing to break them, then we can anticipate, just as I was explaining earlier with the Aussie dollar pair, that perhaps a US dollar relief rally might have gotten underway. But we're going to have to see the factors that I described earlier being met and the requirements being met. What are they? Let me refresh your memories. Positive outcome of the debt ceiling debate, no credit rating cut for the United States, increase in the debt ceiling, no default, and possibly a significant amount of debt reductions and austerity measures that are being announced. I want to bring you back in time a little bit, all the way back to, let's say, a year ago. If you recall at that time, well, if you've listened to any of my webinars at that time, I spoke about the euro and the British pound both actually being rewarded for the fiscal austerities that were undertaken in both of these regions, the Eurozone and the United Kingdom. And at the same time, we spoke about the US dollar being punished for the lack of fiscal austerity in the United States. Can we see the opposite now? If we get to see some significant austerity measures here in the United States, which are debt reduction measures, can that be helpful for the US dollar relief rally? I think it could. But at the same time, we're also going to have to watch the US economic data. Because positive US economic data, faster recovery would mean that the Federal Reserve may begin to tighten policy sooner rather than later. If the U.S. economic conditions continue to deteriorate, then obviously that does not put any urgency on the Federal Reserve to begin tightening anytime soon. Moreover, to quote my exact words, it could actually trigger or cause the need for QE number 3 to rear its ugly head. Why would I say that? Because many of you would recall how detrimental for the strength of the US dollar QE number 1 and QE number 2 have been. If the US economy continues to deteriorate going forward, then the odds for QE number 3 in my opinion, will increase exponentially. Although, of course, the benefits of QE number 3 or 2 or even 1 are a little bit questionable at best. But any consideration of that could certainly mean further debasement of the U.S. dollar and would not be a U.S. dollar positive factor. So we'll watch these previous highs for the pound versus the U.S. dollar. This area with many resistances that are approaching the $1.65 level or a little bit above it. If we start seeing signs of exhaustion and the pound begins to lose momentum, U.S. dollar relief rally could be underway. Especially as next week we could see a reminder that the Bank of England is also not in any hurry to begin the hike interest rates. I don't think that anyone is expecting the Bank of England to do anything with their meeting next Thursday. More than likely, they're going to keep interest rates at the record low level of 0.5%, 0.50. And we also saw the United Kingdom's economy growing at a slower pace in the second quarter of 2011 compared with the first quarter. Although it may not have been as slow as some of the forecasts. It was at 0.2%. Some less optimistic forecasts were only expecting 0.1% growth quarter over quarter in the UK economy. But certainly we're not seeing any kind of sense of urgency with slower growth, and inflation pressures have begun to pull back a little bit from 4.5% to 4.2%, if I'm not mistaken. And so I'm not seeing any urgency for the Bank of England to begin to hike interest rates anytime soon, especially not next Thursday. Now, we're going to follow the Bank of England's interest rate announcement by another major central bank's interest rate announcement, and that's the European Central Bank. The European Central Bank has begun to hike interest rates recently. They have already produced 2 interest rate hikes that have brought interest rates in the Eurozone to 1.5% already. Now, obviously, 225 basis points rate hikes have already, as we noted with last Thursday's estimate for the harmonized index of consumer prices, which is the main gauge of inflation from the Eurozone, preferred gauge of inflation by the European Central Bank, we actually saw the consensus forecast expecting inflation in the Eurozone to remain the same at 2.7%, which is significantly above the 2% comfort level where the European Central Bank prefers to see inflation at. But inflation did not stay at 2.7% year over year. It actually pulled back according to the preliminary flash estimate last Thursday, showing us 2.5% reading year over year. So it's obvious that the 2 interest rate hikes have already taken effect and have caused a little bit of a pullback and brought inflation a bit lower in July, according to the preliminary estimate. So, what do we have? We have subsiding inflationary pressures. We have 2 rate hikes that the European Central Bank has already produced. In that case, are there greater probability that the European Central Bank will hike rates next Thursday? Or will it be the prudent thing to do to sit on the sidelines and pause, at least for August? I think that the second option is the more likely one. I think that after the interest rate hikes, 2 of them, and with inflation already pulling back a bit, the European Central Bank could decide to prudently sit on the sidelines next Thursday. So what does that mean? On top of that, if we get to see the European Central Bank not only sitting on the sidelines, but actually issuing what could be potentially more dovish kind of a statement, that could be another factor that could be put into the list that could be supportive for a U.S. dollar relief rally. Now, the other 2 we said the U.S. doesn't. These are, of course, scenarios that we're preparing for, coupled with European Central Bank sitting on the sidelines and issuing a more dovish statement next Thursday, then we can have all of these factors coming together and possibly contributing to what could become a U.S. dollar relief rally. Now, let's take a look at the daily chart of the euro versus the U.S. dollar ahead of the European Central Bank interest rate announcement and ahead of the new trading week. Just as I was showing you earlier with the pound versus the US dollar, the euro has broken below the bottom of its couple of month channel here that was below $1.3969, serving as the bottom of the channel, and approximately $1.47 serving as the top of the channel. If you've listened to this program for at least the last couple of Sundays, you know what we're talking about. I mean, this has been going on for almost 3 months now. So now the euro broke on concerns about the debt crisis, default by Greece, and so forth and so on 3 weeks ago. But then after the European Union summit, some promising developments there, some bold measures that were being announced by European officials, and then the US dollar really came to the forefront and the problems in the US, in a deadlock on a debt ceiling debate. The euro also took full advantage of the US dollar's weakness, and the euro-dollar exchange rate was sent right back into its previously established range. And where it is right now, actually, as we speak. Now, last week, the euro managed to move as high as $1.4536, but it still has not managed to break above that previous high at the $1.4577. So if the euro manages to muster the strength next week and make that one more push here, those are a couple of resistance points to watch. $1.4536, the high from last week, and also $1.4577. Only a break above these previous resistance levels is going to open the door for the euro-dollar pair to test the top of this channel, which is the $1.4696, roughly speaking, $1.47 area. Just as I was saying earlier, if the euro begins to lose momentum at any of these resistance levels, whether it's $1.4536 or $1.4577, then that could be the early warning signs of the dollar relief rally taking place, a scenario that we're preparing for, possibly for next week. So we'll watch these resistance levels, but for the most part, of course, the euro-dollar pair is trading within a clearly established range. It has familiar resistance levels on the way up, and it will have familiar support levels on the way down. The first one will be $42.50, of course, is the large quarter point there, and the $42.30 was the recent low from Friday. That's an area to watch. Remember these previous lows? The first one was a little bit above $1.41 at the $1.41.02. And then a little bit below $1.41 level, $1.4073. Remember those? We talked about them. Well, on the way down, these are, again, could be familiar support levels that could be challenged as well, especially if the euro continues to fail to break above these two resistance levels, a little bit above $1.45. So a lot of this currency pair's future moves are going to be dependent on the outcome of the debt ceiling debate and vote on August 2nd, on the U.S. economic data throughout next week, and on the European Central Bank interest rate announcement and statement that normally follows it. However, until the top of this range is broken above or the bottom of this range is broken below, we cannot talk about any kind of a trend or a more definite trend direction for the euro-dollar pair. For the last 2 months or so, the euro-dollar is simply trendless, trading sideways. Still doesn't mean that there are no opportunities for to take advantage of these fluctuations within the range, but it's not really a trending currency pair. Now, after the European Central Bank interest rate announcement, we're going to see another major central bank announcing their interest rate decision, and that's going to be the Bank of Japan. Ready to announce their interest rate decision next Friday around 12 a.m. Eastern Time. As usual, the Bank of Japan does not provide an official time for the release of their decision. Just as the other two central banks, I'm not expecting that the Bank of Japan is going to be ready to change its accommodative monetary policy. What's going to be more interesting, however, if the Bank of Japan, provided, has not intervened by then, whether there will be a statement from the Bank of Japan that could hint that there may be an intervention from that central bank who has already done it twice in the last 12 months. September of last year and also March of this year. 2 interventions. In September of last year, the Bank of Japan has intervened by itself. However, in March, after the devastating earthquake and tsunami in Japan, the Japanese yen started strengthening very rapidly, and the Bank of Japan, along with other G7 central banks, decided that it's time for them to curb the strength of their currency, the Japanese yen. That was a very strong intervention attempt, a multilateral intervention rather than a unilateral one. Many of you would recall that the US dollar at that time, and I will show you the daily chart of the dollar versus the Japanese yen currency pair. The dollar at the time has dropped before the intervention to a new post-World War II low at 76.35 yen. Right after the intervention, however, it was a multilateral intervention. The dollar reversed that bearish move and managed to rally about 900 pips after that. Will the Bank of Japan intervene again now that the dollar in the last several weeks has been sold off across the board, and it has slowly but surely grinded lower and lower and lower, getting very, very close now, as of last Friday, to these previous post-World War II lows. The low on Friday was 77.62 yen, which is only within 30 pips or so from the previous record low. So, will the Bank of Japan draw a line in the sand to prevent further appreciation of their currency? We have already seen the first stage of all interventions, and that is verbal intervention attempts. Many Japanese officials, including the finance minister, the Bank of Japan governor, have come out and said that they're watching the currency markets very carefully, that the Japanese yen, they have warned that the Japanese yen moves have been one-sided as of recent several weeks, and certainly they have been one-sided, especially after the dollar broke below the bottom of its existing range. The lows at 79.56 were broken below, and that opened the door for the dollar-yen pair to trail lower and grind lower towards potentially targeting these previous lows. Could the pre-intervention low from March at 76.35 actually serve as a line in the sand from the Bank of Japan? If we get into some really, really bad news in the next 24 hours, I think that the market could continue to push the dollar lower and continue to test the nerve of the Bank of Japan. But what level would be the threshold that the Bank of Japan will say enough is enough and step in to intervene? So far, neither one of these previous lows have been that threshold. So earlier last week, we actually saw some statements and estimates from financial institutions that the Bank of Japan may not be able to produce a significant intervention in this particular period of time that would be in a size of 1 to 2 trillion Japanese yen, as they did before. But I'm not excluding the possibility that at some point the Japanese yen appreciation becomes too painful to bear, and the Bank of Japan steps in and says, okay, this is it, enough is enough, at least for now on. Because you can see even the multilateral intervention strengthened the dollar versus the Japanese yen for a while, a few weeks after that. But then what happened in the months to follow? The bearish trend of the dollar versus the yen simply continued forward. So I'm not talking that the next intervention from the Bank of Japan will necessarily reverse the dollar's negative trend, but it could also be another factor when it comes to the dollar-yen currency pair that could trigger that relief rally that the US dollar might be long overdue for, especially considering that in the last, 1, 2, 3, 4, 5, 6, 7, 8 consecutive trading sessions, we have not seen any significant price correction. of the dollar's losses. That's what the Japanese officials meant when they said that the moves in the dollar-yen exchange rate have been one-sided, which is a code language that they're concerned, and that there may be a potential intervention attempt as early as next week if the dollar continues to grind lower, in my opinion. And even if it actually manages to break these previous lows at 76.35 yen. So it's a very, very important level of support that is ahead of us for the dollar against the yen. If it's broken below, that would exponentially increase the chances for an intervention by the Bank of Japan. Following the Bank of Japan's announcement, we're going to see an important labor market report from Canada with their non-farm payrolls equivalent, the Canadian Employment Situation Report, the main gauge of employment trends and labor market conditions, only an hour and a half on Friday morning before the non-farm payrolls report from the United States. The Canadian economy added 28,400 jobs in June. It is forecast to add up to 20,300 new jobs in July. What does that mean? It means a little bit of a smaller amount of jobs, new jobs created by the Canadian economy. The slowdown in the United States is obviously going to impact Canada, which the United States is the largest trading partner in Canada. So we have to see strength in the U.S. in order for the Canadian economy to also be strong. That is why to a lot of new forex traders, it might be a surprise to see the Canadian dollar actually weakening when we get to see a bad economic report from the United States. I would like to show you the Canadian dollar currency pair really quickly here, if we have the time, to help you visualize what I'm saying. Now, normally, if there's a bad U.S. economic report, we would consider, or at least an inexperienced currency trader would say, well, the dollar should continue to go lower versus the Canadian dollar, right? Wrong. It's actually the opposite when it comes to that, because the close relationship between the Canadian economy and the U.S. economy. So on Friday, we end up seeing the U.S. economy slowing significantly in the first quarter, lower than expected economic growth, and we end up seeing the dollar actually rallying versus the Canadian dollar. So if the U.S. economic data is soft throughout next week, when it comes to the dollar, Canadian dollar, the dollar could be under pressure against other currencies, but maybe not so much versus the Canadian dollar. So the Canadian economy could create a little bit, and by the way, the Canadian dollar has reached new multi-year lows here in the last 3-4 years, new 3-4 year low that we witnessed at 0.94, what was it, 0.9405, 0.9405, the low from July 26th, which was a break below previous lows here at 0.9443 and a break below 0.9422 previous lows. For the most part, however, the pair has managed to find support above 0.94 cents, at least for the time being. Even more interesting than the Canadian employment report next Friday is going to be the U.S. non-farm payrolls report, which is the final top 10 spotlight event, and of course the most important economic event for next week, after the geopolitical event, which is the vote on a debt ceiling on August 2nd. Non-farm payrolls are expected to show a reading of 85,000 in July. Now, this means that the U.S. economy is expected to add up to 85,000 new jobs in the month of July, which would be a faster jobs creation than only 18,000 in June, the dismal report that I mentioned earlier. That really was very disappointing. And in my opinion, also contributed to U.S. dollar weakness. The unemployment rate, however, could remain stubbornly high at 9.2%, which could continue to remind us of the lack of significant improvement in the U.S. jobs market. But at least if the U.S. economy creates up to 85,000 jobs, that might be a little bit more upbeat of employment report than it has been in the last couple of months. So, if we get to see that upbeat economic report, could that be another factor that could contribute to the case of relief rally for the U.S. dollar that may be possible next week? I think that it could. On the other hand, a weaker than expected, another dismal employment report next week would be the third in a row. And a weaker than expected employment report could simply reinforce the Federal Reserve's view of keeping rates low for extended period, maintaining its accommodative monetary policy. It would mean that the Fed will be in no hurry to start tightening anytime soon, and it could even increase the potential for QE number 3. And that could put additional pressure on the U.S. dollar. So if the dollar sees a little bit of a relief rally for a couple of days after the August 2nd deadline, but then we get to see another dismal employment report, that could really jeopardize any relief rally for the U.S. dollar next week. So we have a question from a listener who says, then should we consider a bullish week for the euro versus the U.S. dollar due to all the negative political environment of the United States has faced lately? We should consider that, provided that continues to be the case and we don't get to see some favorable solutions that are being proposed by policymakers in the United States, and we get to see continuation of the deadlock. And on August 2nd, if we don't get any kind of agreement to raise the debt ceiling, obviously that's the worst scenario that could continue to extend the assault on the U.S. dollar that has started a couple of weeks ago. On the other hand, however, as I've been saying all along for the last 1 hour, do not exclude the possibility for a U.S. dollar relief rally. And with that said, I'd like to remind you that this program is intended for educational and informational purposes only, and it should not be considered as giving any buy, sell, or hold recommendations. I'd like to also invite you to visit me on my website, allthingsforex.com, and listen to my daily program, Daily Outlook on Major Currencies, the All Things Forex broadcast. You can find out more details on allthingsforex.com. I'd like to thank our friends at fxstreet.com for putting together these series of webinars. Thank you all very much for joining me today. Have a great week ahead of us and happy trading. Goodbye.